Let's start the clock. So Asia plays catch up then, Mark, and a couple of big themes. There's the yield theme that we talked about a lot last week, but lives on very much into today's conversation. And there's commodities, which adds further momentum perhaps to that yield dynamic, as it is based on such fears around inflation. Let's just underline, though, I know we're going to talk in around half an hour's time about the European side of this, and in fact the global phenomenon that has been and is decreasingly negative yielding debt. But we have seen such a pivot from so many central banks around the world. There's no denying the global move towards hawkishness, apart from in China, I suppose.
Yes, China really stands out as the exception. And I wonder how long that can go for in a world where we're changing, where we're going to get rid of TINA, because we're going to have to move to a world where central banks are acknowledging inflation. So we're going to get rid of that negative yielding debt. We're going to move to a world slowly of positive yields, or at least close enough. And that means we've got a much further to go in global bond markets over the next year. At some point, that might stop China from easing too much, but they might still stand out by not hiking as much. And I think it is that divergence, the idea that China will be more stable on policy and might even be trying to ease in the first part of the year, is why equity markets in China and Greater China, so even Hong Kong as well, can do really well, because they're the ones that were massively discounted last year as US and European equity markets surged.
Yeah, and I know that you're thinking a lot about Chinese tech and whether that's a good play, and you've been asking on the Markets Live question of the day, can China replace the US as the best tech trade? Let me ask you what you learned from the jobs report, though. We'll talk about this with our guests shortly, Mark, but from the jobs report, did you take anything away? Did you take away this theme of further hawkishness, or did you take away a whole lot of confusion? Because there were so many strange things going on behind the scenes when it comes to that month of jobs data from the US.
It was strange, but to me it was still a very strong message. And I think there was a few things. One is really strong job gains despite the Omicron effect. Second of all, the message is clear because all the revisions for the past 5 months have now been higher than the initial reading. So therefore, the jobs market continues to be much stronger than we were thinking only a month or so ago because of those revisions. And third, the most important, in fact, because we said going into the jobs number, the most important thing to look at was those average hourly earnings. And not only did they beat every possible estimate, just like the headline job gains, but the revisions were again higher. So this emphasizes the economy is strong and the inflation problem is much bigger than policymakers were thinking only maybe even 2 months ago.
You love a bit of data, Mark, that looks as if it adds to the inflationary dynamic and catches all of the economists offside. So that's the average earnings. More on that in a moment. Just briefly, crypto. Are you getting interesting signals from crypto? Because we seem as if in 2022 we're treating it much more of an indicator of risk assets.
Yeah, particularly in the last couple of months. Since about November, it seems to have led markets in the very short term. So I am interested in how well crypto is trading today. It surged on Friday, did well over in the weekend. Maybe that suggests we're due a little bit more of a reprieve for US tech in the very short term. Ultimately, though, I think it'll sell the dips market.
OK, Mark, thank you very much for thoughts so far. You can get all of the analysis from Mark and the rest of the Markets Live team, of course. MLIV GO, that is the function to use on your terminal.